Most traders believe bigger gains come from bigger risks. That's the first mistake. The market doesn't reward boldness the way you think. It rewards alignment. And if that sounds vague, good. Because most people rush past that idea without ever understanding it. Let me ask you something. Have you ever noticed how your largest losses often come right after you feel the most certain? That's not coincidence. That's cause and effect. Watch your own behavior for a moment, not the charts, your behavior. You enter a trade, it moves slightly in your favor, confidence grows, you add more size, then the market hesitates, you hold, it pulls back further. Now you're not trading anymore, you're defending, you're hoping, you're stuck. Why does that pattern repeat? Because most traders act strongest when they should be cautious and hesitate when they should be aggressive. Have you ever wondered why your biggest winners are often smaller than they should be, while your losses seem to expand without permission? It's not bad luck, it's misaligned timing between conviction and evidence. The market doesn't pay you for being right, it pays you for being right at the right time, and pressing when the odds are actually in your favor. There's a difference. You see, bigger trading gains don't come from forcing trades. They come from recognizing when the market is already doing the work for you. Think about that carefully. When a stock is truly strong, does it need your encouragement, or does it move with a kind of quiet persistence? Pullbacks shallow, momentum steady, resistance levels breaking without hesitation. Now compare that to the trades you hope will work. They stall, they chop, they test your patience, and yet those are the ones traders tend to overcommit to. Why? Because the mind confuses effort with opportunity. The harder something feels, the more you want to justify it. But the market doesn't care about your effort. So let me ask you, what if the trades that feel the easiest to hold are the ones you should be sizing into? If that's true, and it is, then most traders are positioned backwards. They go big when uncertain and small when the evidence is clear. That's why their results feel inconsistent. Not because they lack skill, but because their timing of aggression is off. Bigger gains require a shift. Not in strategy, but in behavior. You don't start big. You earn the right to get big. That's a subtle distinction, but it changes everything. When a trade begins, your job isn't to predict the outcome. It's to observe how the market responds. Does it confirm your idea quickly? Does it move cleanly? Does it attract follow-through? Or does it hesitate? Because hesitation is information. And here's where most traders go wrong. They ignore that information when it contradicts their initial belief. Have you ever stayed in a trade longer than you should have, simply because you didn't want to admit it wasn't working? That's not a trading problem. That's a psychological one. So what do you actually do with this? You scale your conviction based on market behavior, not your opinion. Start small, always, then watch closely. If the trade proves itself, if price moves in your direction with strength, if pullbacks are controlled, if volume supports the move, you add. Not randomly, but deliberately. Each addition is not a gamble, it's a response. You're not predicting anymore, you're aligning. And if the trade doesn't confirm, you reduce, or exit, quickly. No debate, no hesitation. Because small losses are part of the process. Large losses are a failure of discipline. Now think about this. How often do you give your losing trades more time than your winning ones? That habit alone can destroy your edge. Instead, flip it. Give your winners room. Give your losers none. Simple to say, difficult to practice. Why? Because it feels unnatural. Cutting a loss quickly feels like admitting defeat. Holding a winner feels like risking what you've already gained. But in trading, what feels safe is often dangerous, and what feels uncomfortable is often correct. Bigger gains also require patience. Not passive waiting, but active observation. There are long stretches where the market offers nothing worth acting on. Most traders can't tolerate that. They need action. They need movement. So they create trades where none exist. Have you ever taken a setup that looked almost right, just because you didn't want to miss out? That, almost, is expensive. Because the market rewards precision, not approximation. The best opportunities are obvious, not because they're easy to see, but because they behave cleanly once they begin. And when you find one, your job isn't to hesitate, it's to act, and then stay with it. That's where the real gains come from. Not from catching every move, but from holding the right move long enough. But here's the part most people miss. Holding a winning trade is harder than entering one. Why? Because now you're dealing with success, and success introduces a new set of fears. Fear of giving back profits, fear of being wrong after being right, fear of holding too long. So what do traders do? They exit early. They take small profits and feel relieved. But relief isn't the goal. Growth is. So you have to ask yourself, are you trading to feel good or to perform well? Because those two objectives often conflict. And this brings us back to the core idea. Bigger trading gains are not unlocked by doing more. They're unlocked by doing less, but doing it better. Fewer trades, better timing, stronger alignment, and most importantly, the discipline to press when it matters. Because opportunities in the market are not evenly distributed, they come in clusters. Periods of clarity followed by noise. If you treat every moment the same, you dilute your results. But if you learn to recognize when the market is offering something real, something with momentum, structure, and confirmation, then you have a choice to make. Do you stay small and play it safe? Or do you step in, increase your exposure, and trust the evidence in front of you? That decision right there is where most traders hesitate. Most traders believe bigger profits come from taking bigger risks. They think larger position sizes, faster entries, and bold decisions are what separate average traders from exceptional ones. But that belief quietly damages more accounts than poor analysis ever does. Bigger gains are not created by reckless exposure. They are created by knowing when to increase aggression, and when restraint is the wiser move. Think about it for a moment. Have you ever taken a large position simply because you felt strongly about a setup, only to watch the market move against you almost immediately? What looked like confidence was often premature commitment. You were aggressive before the market gave you permission. That is where timing becomes everything. Aggression in trading is powerful, but only when it is used at the right moment. Used too early, it becomes force. Used too late, it becomes hesitation. Used correctly, it becomes leverage on opportunity. That difference is what separates consistent traders from impulsive ones. The market leaves clues before meaningful moves unfold. Price begins to hold above important levels. Pullbacks become shallow. Volume increases without dramatic resistance. Momentum starts building with less friction. These are signs of alignment. This is when strength is no longer your opinion. It becomes visible behavior. Now ask yourself, when do most traders become aggressive? Usually before these signs appear. They act on anticipation, not confirmation. They commit heavily because they believe they are early. Thinking early always means better profits. But being early often means being wrong for longer than expected, and that drains capital, confidence, and discipline. The wiser trader waits. Not because he is fearful, but because he understands that patience sharpens aggression. Waiting allows uncertainty to shrink. It allows evidence to build. Then, when the market clearly reveals direction, aggression has purpose behind it. This changes how you trade. Instead of entering heavily at once, you begin with measured exposure. You test the market's reaction. If price confirms your idea, you press further. If it hesitates, you reduce risk quickly. Your size grows with proof, not hope. Your aggression follows strength instead of trying to create it. That approach may sound slower, but it often produces larger gains. Why? Because capital is concentrated where conditions are strongest, not scattered across mediocre setups. Losses remain controlled, while winning positions receive greater commitment only after they demonstrate real potential. This also changes your psychology. When aggression is timed correctly, fear becomes quieter because your decision is supported by evidence. You are no longer forcing belief onto the market. You are responding to what the market is already showing. That creates calm conviction, and calm conviction holds positions longer than emotional excitement ever can. And that is where meaningful gains begin. Not in dramatic risk-taking, but in disciplined timing. Not in acting bold, but in knowing exactly when bold action is justified. Many traders believe conviction is what produces results. They trust their analysis, form a strong opinion, and then cling to it with determination. In their mind, confidence feels like strength. Stubbornness feels like discipline. Holding firm feels admirable, but the market has no respect for personal conviction. It rewards alignment with real strength, and there is a profound difference between the two. Have you ever watched a trade fail while still believing your original idea was right? You kept telling yourself the market was mistaken, that price would eventually come back, that patience would prove your analysis correct. Yet, while you were defending your opinion, the market was revealing something more important. Your opinion was no longer aligned with reality. That is where many traders lose money, not because they lack intelligence, but because they confuse being committed with being correct. Conviction is internal. Strength is external. Conviction is what you think should happen. Strength is what price is actually doing. One is belief. The other is evidence. A stock can look perfect on paper, supported by strong fundamentals, clear technical structure, and a convincing story. You may study it deeply and build complete confidence in your thesis. But if price struggles to move higher, if rallies quickly fade, if support levels repeatedly weaken, if buying pressure lacks persistence, then the market is telling you something your analysis cannot ignore. Real strength has a signature. It moves with purpose. Pullbacks remain controlled. Buyers step in without hesitation. Resistance begins to break under pressure. Weakness gets absorbed quickly. Price does not need constant justification. It behaves strongly because demand is genuinely present. Now ask yourself, how often have you stayed loyal to weak price action simply because your idea made sense? That loyalty is expensive. The market does not pay traders for having intelligent opinions. It pays traders for recognizing where real force exists and aligning themselves with it. This requires humility, because sometimes the setups you love show weakness, while the opportunities you overlook begin showing undeniable strength. The stubborn trader resists that reality. He keeps trying to force the market to validate his belief. He averages down, adds more size, and treats weakness as opportunity simply because he refuses to detach emotionally from his original view. The wiser trader watches behavior, not attachment. If strength appears, he leans in. If weakness appears, he steps aside. Simple in principle, difficult in practice, because the mind becomes attached to being right. But trading is not about protecting your ego. It is about responding to truth as it unfolds. Alignment changes everything. When your position is aligned with genuine strength, holding becomes easier because the market confirms your decision through action. Confidence becomes calm, not emotional. Patience becomes natural, not forced. Your conviction is no longer built on hope. It is reinforced by visible proof. That is a different kind of confidence. Quiet confidence. Measured confidence. The kind that comes from seeing strength repeatedly confirm itself through price behavior, volume, momentum, and market response. Most traders make one costly mistake. They commit heavily before the market confirms anything. They see a setup they like, feel conviction rising, and immediately put significant capital behind an idea that has not yet proven itself. In that moment, they are not responding to strength. They are betting on expectation. And expectation is dangerous when it comes before evidence. Have you ever entered a trade with confidence, only to watch price hesitate the moment you got in? Suddenly, what looked clear becomes uncertain. Momentum fades. Buyers disappear. The move you expected never develops. Now you are trapped between hope and fear, holding a position that asked for trust before earning it. This is why pressing size too early quietly destroys consistency. A winning position should prove itself before it deserves more capital. That principle sounds simple, yet very few traders practice it. Most want immediate reward. They want the full position on from the start, so they can capture every point of the move. But markets do not reward impatience. They reward discipline scaling into confirmed strength. Confirmation matters because price behavior reveals truth faster than opinion ever can. When a trade is right, it often begins showing signs quickly. Price moves with purpose. Pullbacks remain shallow. Support holds naturally. Volume expands where it should. Resistance levels begin breaking without heavy struggle. The market starts validating your idea through action, not theory. That is when size becomes intelligent, not before. Ask yourself, why put your greatest risk on your weakest certainty? At the moment of entry, uncertainty is highest. You have an idea, but no proof. The trade has not moved. It has not confirmed direction. It has not shown strength. That is the stage where risk should be smallest, because information is limited. Then something important happens. The market responds. If it confirms your thesis, uncertainty shrinks. Probability improves. Conditions become clearer. Now increasing size is no longer blind aggression. It is calculated commitment backed by evidence. You are not adding because you feel excited. You are adding because the market is demonstrating strength. That difference changes everything. Your capital begins following proof instead of prediction. Your confidence becomes grounded. Your decisions become cleaner. And your losses stay controlled because failed ideas are identified early while promising ideas earn greater attention. This is how strong traders think. They test first. They observe carefully. Then they press when strength becomes visible. Not when they hope. Not when they guess. Not when they feel certain. Only when the market confirms what it is already beginning to reveal through its own behavior. Because true opportunity does not ask you to force belief into it. It quietly proves itself, step by step, until pressing size no longer feels like risk, but like disciplined alignment with strength that is already unfolding. Then patience turns into action. Then action turns into conviction. Every trader accepts the idea of losses, but very few truly understand the difference between a small loss and a large one. They treat both as part of trading, as though they belong in the same category. They do not. One teaches, the other punishes. A small loss is information. A large loss is usually refusal. Have you ever watched a manageable loss slowly grow into something painful, or because you kept giving it more time? At first, the position moved slightly against you. Nothing alarming. You told yourself it was normal market noise. Then price slipped further. You adjusted your expectations. Then deeper still, and now your thinking changed completely, from objective decision making to emotional defense. You were no longer managing risk. You were negotiating with reality. That is where damage begins. Small losses are part of disciplined trading because no trader can predict every move correctly. Even the strongest setups fail. Even clear opportunities break down. That is normal. A small loss simply means your read on timing, direction, or conditions was wrong. The market gave feedback, and you paid a modest price to receive it. That payment is tuition. It teaches you what weak price action looks like. It teaches you where your timing was off. It teaches you whether your judgment matched real market behavior. Most importantly, it keeps your capital intact so you can act when better opportunity appears. Now ask yourself, why do traders allow small losses to become large ones? Because exiting small feels uncomfortable. It feels like admitting you were wrong too quickly. It feels frustrating to take a loss and watch price possibly recover later. Pride becomes involved. Hope enters quietly. Then logic starts bending around emotion. The trader says, I'll give it more room. Then, it's oversold. Then, I'll average in. At every step, weakness is being mistaken for opportunity simply because accepting reality feels harder than resisting it. But markets punish resistance. Large losses rarely happen instantly. They grow in stages. First denial, then rationalization, then emotional attachment, then paralysis. By the time action is finally taken, the damage is deep, not only financially, but mentally. Confidence weakens. Discipline breaks. Future decisions become clouded by fear. One large loss can distort 10 good decisions. That is why disciplined traders protect themselves early. They understand something critical. Being wrong small is inexpensive, but being wrong large steals both capital and clarity. They cut weakness before weakness grows. No debate. No attachment. No waiting for hope to rescue poor positioning. And because they keep losses small, they remain flexible. Their mind stays clear. Their confidence stays steady. Their capital stays available for stronger opportunities. That is how survival becomes strength. Small losses sharpen judgment. Large losses damage judgment. One teaches discipline. The other exposes the absence of it. And in trading, discipline is not measured by how confidently you enter a position, but by how quickly you recognize when the market is showing you that your idea is weak, your timing is wrong, or your read was premature, take the lesson. Pay small. Move on. Protect clarity. Most traders wait for obvious weakness before they become cautious. They wait for a sharp drop, a heavy sell-off, or clear damage on the chart. By then, the warning has already passed. The market often whispers weakness long before it speaks loudly, and that whisper usually appears as hesitation. Price hesitation is one of the most overlooked signals in trading. Not because it is hidden, but because it looks harmless. Have you ever entered a trade expecting momentum, only to watch price stall near your entry? It does not break higher. It does not collapse either. It simply lingers, moving sideways, drifting without commitment. At first, this seems normal. You tell yourself it is consolidating, building energy, preparing for the next move. Sometimes that is true. But often, hesitation is quiet weakness revealing itself before visible decline begins. Strong price action has character. It moves with intent. It reacts cleanly. When buyers are truly in control, pullbacks are brief and recoveries are decisive. Resistance levels weaken under repeated pressure. Dips attract interest quickly. Momentum feels supported, not forced. There is flow in the movement, a sense that price is being carried by genuine demand. Weakness behaves differently. Progress slows. Breakouts fail to follow through. Small rallies lose energy quickly. Price revisits support too often. Momentum becomes uneven. What appears to be rest may actually be hidden exhaustion. Ask yourself, how many times have you mistaken stalling for strength simply because price had not fallen yet? That mistake is expensive because hesitation changes probability. A market that cannot move cleanly in favorable conditions is revealing friction beneath the surface. Buyers may be losing conviction. Supply may be quietly increasing. Larger participants may be distributing shares into optimism while retail traders interpret sideways movement as opportunity. The chart looks calm, but underneath, pressure is building. This is why reading behavior matters more than reading headlines or clinging to a prediction. Price action communicates condition. Hesitation is often its early warning language. Not every pause means weakness. That is where observation becomes skill. Look closely at how price behaves during hesitation. Does volume dry up naturally while support remains firm? Or do rallies weaken while selling pressure quietly grows? Are pullbacks shallow and controlled, or are rebounds becoming weaker each time? Is the market pausing with strength, or pausing because it lacks strength? There is a difference. One is healthy consolidation. The other is fragile structure. The disciplined trader learns to notice these subtle shifts early. He does not wait for obvious collapse to tell him what quiet hesitation was already suggesting. He respects stalling behavior when momentum should be present. He becomes alert when price stops acting as strong positions should act, because weakness often starts with loss of urgency, then loss of momentum, then loss of support, then visible decline. By the time decline becomes obvious, smart money has often adjusted long before. Watch hesitation. Study stalls. Notice fading energy. Most traders think patience means doing nothing, sitting on their hands, waiting passively, avoiding action until something obvious appears. But that is not real patience in trading. Real patience is disciplined observation. It is active, sharp, and deeply intentional. Patience is not inactivity. It is controlled readiness. Have you ever felt the urge to take a trade simply because the market was moving, even though nothing truly stood out? You watch candles form, price fluctuate, momentum shift from one direction to another, and suddenly the need to act grew stronger than your need to wait. Not because opportunity was clear, but because stillness became uncomfortable. That discomfort traps many traders. They mistake movement for opportunity. They mistake action for progress. They mistake participation for discipline. But markets spend much of their time creating noise, not clean opportunity. Price moves up and down. Breakouts fail. Momentum appears, then disappears. Structure forms, then weakens. To the impatient eye, every move looks tradable. To the disciplined eye, most of it is distraction. That is where patience becomes edge. The patient trader is not simply waiting. He is watching closely. He studies how price reacts at important levels. He notices whether momentum has followed through or fades quickly. He watches volume expand or disappear. He observes whether pullbacks are controlled or unstable. He listens to behavior before committing capital. Ask yourself, how often have you entered a trade because you were tired of waiting, only to realize later that your setup was built more on impatience than clarity? That is expensive impatience. Real patience sharpens decision making because waiting filters weak opportunities out of view. Time exposes fragile setups. What first looked promising begins showing hesitation. Momentum fades. Structure weakens. By waiting, poor trades reveal themselves before your money becomes involved. At the same time, strong opportunities often become clearer with patience. The best setups rarely beg for attention early. They build quietly. Strength develops in layers. Support forms naturally. Resistance gets tested repeatedly. Volume starts confirming interest. What was uncertain becomes increasingly obvious to the trained eye. Now action has meaning. Now timing improves. Now conviction is supported by evidence. That is disciplined waiting. And patience has another advantage. It protects emotional energy. Constant trading creates constant decision fatigue. Every entry demands judgment. Every position creates stress. Every loss creates reaction. The trader who acts too often becomes mentally noisy, and a noisy mind struggles to read markets clearly. Patience creates mental clarity. Clarity improves judgment. Better judgment improves timing. Better timing improves results. Simple cause and effect. This is why disciplined traders can sit through long stretches without acting. They understand that no trade is often the smartest trade available. Preserving capital is productive. Preserving focus is productive. Waiting for clean alignment is productive. Because the market does not reward constant effort. It rewards selective action. Watch carefully. Wait deliberately. Let weak setups pass. Let strong ones reveal themselves. One of the strangest habits in trading is this. Most traders become patient with losing positions and impatient with winning ones. They hold weakness with hope, yet they cut strength with fear. They protect what should be removed and remove what should be protected. That reversal quietly keeps profits small and losses heavy. Have you ever noticed how quickly you want to take profit when a trade moves in your favor? The moment unrealized gains appear, your thinking changes. You begin calculating what you could lock in. You imagine price reversing. You fear watching profit disappear. Suddenly, a winning position feels fragile, even when the market is showing strength. So you exit early. You take the quick gain. You feel relief. But relief is not always wisdom. Now compare that behavior to a losing trade. Price moves against you. Instead of exiting quickly, you become patient. You tell yourself it needs room. You wait for a bounce. You search for reasons to stay. You become flexible with your rules. Time that should have belonged to strong positions is now being given to weak ones. Ask yourself, why are traders so generous with losers and so strict with winners? Because emotion reverses judgment. Loss creates hope. Profit creates fear. Hope whispers that weak trades can recover. Fear whispers that good trades can vanish. And traders listen. That is where results become distorted. Strong trades often need time to fully develop. Markets rarely move in straight lines. Even powerful trends pause, pull back, and test conviction. If you cut every winner at the first sign of discomfort, you never stay long enough to capture meaningful movement. You keep harvesting small gains while missing the larger opportunities strength was building toward. Meanwhile, weak trades often reveal their weakness early. Price hesitates. Momentum fades. Support fails to hold. The position no longer behaves the way strong setups should behave. That is information. But instead of respecting it, many traders become emotionally invested in recovery. They manage losers carefully. They abandon winners carelessly. That is backwards. Winning positions deserve attention because they are aligned with strength. They have proven themselves. They are showing behavior worth respecting. These are the positions that deserve patience, observation, and room to work. Losing positions deserve scrutiny. If weakness appears, risk should shrink. If structure breaks, exit should follow. No negotiation, no emotional attachment, no endless waiting for what price is no longer showing. This shift changes everything. You stop treating profit like something to escape with. You stop treating loss like something to rescue. You begin letting strength breathe. You begin cutting weakness fast. That is how asymmetry develops in trading. Small controlled losses, larger sustained gains. Not because you trade more, but because you stop interrupting what is working and stop defending what is failing. Protect winners. Question losers. Be patient with strength. Be ruthless with weakness.